Hi, it's Rick with your long overdue, but eagerly anticipated video series on building and managing a stock portfolio. Got to admit, I just did this a little while ago, and it's very helpful if you turn your microphone on. So after recording for a half hour or so, I'm going to review it. Here I am, going to start all over again. But hey, technology is not my best friend. So I'm gonna break this into 4 separate videos. First of which today will be what do I buy, followed by how can I find them, which will deal with screening, scanning. 3, when do I buy them, which is more on market or stock timing. And then the 4th, which is probably the most important of all, position sizing and risk management. So the what do I buy, pardon me, is probably the least important, particularly of 3 and 4. We all want to buy stuff that we think is going to go up. So simply put, we'll sell quickly if we're wrong, and we'll hold on for as long as we can if it's going up. So in the what do I buy category, what I'm looking for is stocks that have the highest probability that I think is going to go up. So that's what this series will deal with. How can I find these stocks? I'll show you my main screening tool, and then I'll give you a couple other options or things to look at, or you can research these on your own, but you'll get an idea how my scanning universe works. The when do I buy them? It's not the lowest price that matters, really. It's the best price. And this will become more evident as we look at some examples in the 3rd video. And then the 4th is what I call the holy grail of to minimizing losses and maximizing gains, and that is position sizing and risk management. So in my prep for this series, which I've been working on now for about 2-3 weeks, I guess, it really opened my eyes to my own trading results. And as I looked at dozens of charts of stocks that I've bought and looked at my rules and where I'm kept within them and where I went outside them and so on, it has really, I believe this, just doing this alone, whether it's a benefit to you, I hope it is, but it certainly is going to be a benefit to me. Full transparent, I'm down 10% for the year, and I'm just not happy about that one little bit. I could take some solace in the fact that the S&P is down 25%, the QQQ is down 35%, and even Toronto is down 17%. But for me to be down 10% is way beyond my, I won't call it pain threshold, but where I really should be with my level of expertise. And why is that? And this, in the prep here, really opened my eyes up in that I really suck at the when do I buy them part of the series. And so we'll discuss that in more detail when I get to that section. But I really tend to anticipate, and I don't buy correctly. And as a result, I'm not in the wrong stocks necessarily. I'm right, but I end up losing or not making very much. I've already set some goals for 2023. I don't know what 2023 will look like, but we don't know how 2022 is going to end. But if my goal on the downside is if the market continues down and we end 2023 down 10, 20, 30%, regardless of where it ends, my goal is to keep my drawdown to less than 3%. I should not experience a drawdown in my portfolio value of more than 3%, because I'm going to remain disciplined, and when the conditions are not good, I'm just going to be out. And when I'm going to be in on appropriate size, it's like tiny size when things are not going good, so that I minimize my losses. On the other hand, if the market manages to recover next year and goes up, let's say it goes up 20%, recover some of the loss from this year. My expectation is my account will double or triple the benchmark. So if the index goes up 20%, I expect that my portfolio next year will be 40 to 60% higher. And I don't think that's unattainable. Just as an aside, the U.S. Investing Championship has been a competition now. It's been going on for about 30 years or so. And every year, professional and quasi-professional traders sign up for this and disclose all of their trading history and their account balances. And this year, there's 291 entrants, and only 23 of them, or 8% of the total, are actually showing a profit. So that's some indication of how tough this has been, so that the pros are not making money. However, 11 of those 23 have had gains of 10% or more, so that's encouraging. And the leader is actually up 332%. Now, I have no idea how they've done that. This is only with stocks, so they're not allowed to use options or futures. So maybe they have a big short selling strategy. That's not mine, but that could be one component for it. And in the second place so far is up 150%. I also, some of you know, I'm a sort of a mentor participant in Mark Minervini's service. I noted 3 of the top 10 names are students in his group. So I think we're on the right track. So let's, I'm going to start with a little basic stock 101. So why do stocks go up or down? I mean, I get this question all the time, like what happened to the market? What happened today? Or what happened to stock XYZ, whatever. It really boils down to simply supply and demand. No more complicated than that. When stocks go up, that means there's more buyers than sellers, and that makes the stock go up in value. And, even my 11-year-old granddaughter understands this concept. And I'll show you something here if I can just get e-signal. And we're going to look at Amazon. It was about this, I know it was around Christmas time last year that I said to Ella, my granddaughter, I'm going to buy you 1 share of stock. What is a good company? What is a company you would like to own? And after thinking about it for a week or two, and it was some prompting, she finally said, you know what, Amazon. She hadn't obviously looked at charts or anything else, just said Amazon. I said, oh, great, okay. She had to pick the most expensive one. At the time, this was trading pre-split, and it was about $3,500 a share. But nevertheless, I went out and bought her and her account 1 share of Amazon. I believe we paid $3,500. And what she did was, I guess maybe am I urging, I don't know. She, as we all do, we on our phones, most of us, I'm sure, have got the little app there that tracks our stock prices. And she put on Amazon, and every few days she'd say, hey, Grandpa, I'm up $50 on my Amazon. Grandpa, I'm up more on my Amazon. It's going good. And then I don't remember the exact timing, but it was somewhere around early January or so. Grandpa, Amazon's going down. So then I pulled up a chart for her, and we'd have to rewind the video back to here somewhere. I guess it was. I can't remember exactly what day it was. But anyway, she said, I said, what do you think we should do? Should we sell it? Yeah, I think we should sell it. Okay. So I said to her, what's another good company that we should buy? She said, how about Disney? Okay, well, this time though, let's have a look at the chart first. So I pulled up Disney. And again, the time frame here, we're back into, middle of January-ish. And she looked at this and said, "Oh, I don't like that." So, I mean, if an 11-year-old can get the concept, not necessarily without understanding it, by looking at pictures of supply and demand, sure as hell we can, us should be able to get this. So what drives demand? What is the main thing that drives demand? And in my view, it's earnings, or at least the prospect of earnings. That's the main driver. So that's my number one focus when I look at a company from a fundamental perspective. I mean, I can see a pretty chart, but I want to know what their earnings are, what they've been doing. So that's the number one driver for me. So the factors that can affect earnings, anybody that's been in business understands that there's three drivers: sales, margins, and costs. So a great company would have increasing sales, increasing margins, and lower costs. That's a good recipe for strong earnings growth and makes it quite investable. You could have a company that is growing in sales, but margins and costs are staying relatively constant. But even then, again, your earnings are going to be growing quite nicely. Where I might get a little concerned and dive a little deeper is if sales are flat, margins are flat, but costs have come way down, and that's boosted their earnings. That's not a bad thing, but how sustainable is that? It may not be sustainable, and the market is looking out 6 months to 12 or beyond. So that's sort of a preamble to that. Some of the headwinds that we have to pay attention to that can affect the market as a whole. And if things affect the market as a whole, obviously it's going to affect most of the stocks, is inflation, recession, whether we're going into are in recession, going into recession, how deep the recession, how long will it last, unemployment rates, competition, market share, innovation, interest rates. Interest rates is an interesting one because that's what we're all facing that right now, and it can be somewhat devastating depending what you're in. Again, we'll go back to my favorite charts, and if we look at what impact has interest rates had on bonds, and it's been catastrophic. Bond prices since last October have plummeted and showing no signs of stopping. And as interest rates keep going higher, this keeps on going down. So anybody tells you bonds are safe, yeah, take a look at this chart. And even I hate to pick on, I love to pick on Canadian banks. I used to work for these guys 100 years ago. And even that stock is not pretty, and that's a function of interest rates. Now, you'd say a bank, well, they can pass on interest rates by charging more for their loans, but the flip side of that is they have to pay more to get the savings, and so their spreads, pretty much the same. I would argue that most people invest in the banks because of their dividend yield. And it's been constant, it's been steady, they're very predictable. And I think last time I checked, the Bank of Montreal pays a dividend equivalent to 5%, which is pretty good yield. But you know what? If your stock is down 30%, and you're only getting 5% in a dividend, simple math is you're going to take 6 years to get back to even. So anyway, interest rates can have an impact. And then certainly we have to pay attention to what's going on with respect to wars. There's a military war in Ukraine that's having an impact. If you're in the defense contractor business, you're doing okay with that. If you have a good supply of wheat to replace what's been displaced in Ukraine, you're doing fantastic. But generally speaking, you got to pay attention to what could happen there. And then I would argue we're in an economic war. The U.S. is at a war with Russia with respect to sanctions, and now it looks like China. So what impact is this? So these are all headwinds that we have to pay attention to the overall market. They don't influence my individual stock picking, but we have to pay attention to these things. So what do I buy? What is my particular strategy? There are dozens of strategies. You could, as I mentioned earlier, you could be a short seller. You could just bet against the market, and that could be your strategy. You can be a bottom fisher. Stocks that are down 70%, you say it can't go any lower. So you start buying those on the expectation, the hope that they're going to go back up. You could use all sorts of indicators, RSI and stochastics and MACDs, and God, there's thousands of different indicators, and say when this crosses that, then that's when I buy. Yeah, to me, I boil it down. I boil it down to the second line here was basically I want to buy high and sell higher. It just, to me, is the highest probability of a stock going in the right direction. There is we'll get on that in a second. So I follow what's called the CAN-SLIM method, which was coined by William O'Neill, the founder of Investors Business Daily, and arguably one of this century and last century's best investors, greatest investors. All followed the readings of Jesse Livermore, Nicholas Darvis, and a whole bunch of like renowned investors. CAN-SLIM is an acronym for C means current earnings. A is annual earnings. So you can see the fundamentals, it's all about earnings. The N stands for new. So I'd love companies that have got new technology, new products, perhaps new management. They're setting a new high for their stock price. There's something new going on there. S is supply and demand. And so we're looking for stocks that have low supply, high demand. L is this company a leader in its industry, or is it a laggard? We want to invest in leaders early on, especially when we're coming out of a bear market. We want to identify those leaders and ride that puppy as long as we can. When you're in the late stages of a bull market, then sometimes those are way out of reach, and you're forced to look at laggards because eventually money's got to go somewhere, and even the laggards will attract some attention. But now, I stands for institution, so it must have institutional support. Your Aunt Betty, Uncle Bob buying their 1,000 shares of XYZ is not going to drive the price of the stock. It's the Vanguards, the Fidelities, the Invescos, and so on and so forth, institutions that are buying millions of shares that are going to influence the stock price. So the stock should have good institutional support. And the M stands for market, the market as a whole. Studies show that 75% of all stocks will react to the market. Again, you have to know what the market is doing. Are market conditions favorable or unfavorable? But if I, as an aside, if I'm looking at a stock that relatively just follows the market, probably Apple, Microsoft, Google, Intel, Cisco, IBM, whatever, GE, then I'd rather buy the index than buy that stock, because a stock you can have what's called single stock exposure. So if something really bad happens to that particular stock, not the price, but something happens to the company, can have a big negative impact on the price of the stock. Whereas buying the index, you're safe from that. So you could Google this and research it. It's well worth doing some reading here. If you're looking for some books, certainly How to Make Money in Stocks by William O'Neill is one of the prerequisite readings. The one thing I will say with this methodology is looking for high potential growth stocks. And this works very well in bull markets. It works okay in a sideways market, but it works poorly in downtrending markets, such as we're experiencing now for the last year. It's just there are so few setups that meet their criteria. And even when they do, just the overall market tends to, an institutional lack of support tends to hurt them. So this system, I mean, you get aggressive when things are going good, but you basically sit out the market or just play very tiny in down markets and have good discipline. So people might ask, oh, well, okay, when you're in a bear market, why don't you switch strategies? You know, the canceling method is not working. Find something else that might work. There's a whole learning curve there. And what I want to do is become an expert in one thing and not get drawn into looking at several different things, being a master of none. I use the metaphor of, you know, you're an eye and ears and note doctor, and business is way down because of the seasonality of it. There's no asthma out there. There's whatever. Nobody's really having those kinds of issues. So this isn't good. So you know what? I'm going to dabble in heart surgery for a while. Yeah, no, doesn't work. So essentially only invest in stocks with good fundamentals and good technical patterns. So what are those? So the fundamentals that are going back to, or that I pay attention to, is increasing earnings and increasing sales. So those are the two metrics that I mostly focus on from a fundamental perspective. Now, I will make an exception in the biotechs, because a lot of biotechs are awaiting approvals for various things. So they may have some tiny sales, they may have no sales, but they probably rarely have earnings. But I will entertain them if the chart pattern is compelling. If the charts and the data shows me that institutions are investing heavily in this company, despite the fact of revenues and earnings, they're onto something. You know, they've got big research departments. They're probably onto something. So I will make some exceptions, but the pattern's got to be pristine. A couple of the things I look at from a fundamental perspective is what's called an up-down volume ratio. So this just really measures the volume on up days versus the volume on down days. And we want to see this greater than 1-to-1. So which just means if you're like 1.3, 1.5 is the ratio, there's much stronger volume on an up day than there is on a down day. So an up day is signs of accumulation. Big volume on a down day is signs of distribution. So institutions are unloading. So you want to be on the right side of that. I also pay somewhat attention to return on investment. My threshold number is like 17%. To use an example, if you and 6 of your friends put together some money, let's say you raise $1 million and you form ABC Widget Company, and you don't take on any debt, and out of that $1 million investment, after tax you net $250,000, then you have an ROI of 25%. So you're earning 25% on your $1 million. That's pretty darn good, better than putting in the bank. You can even juice that up a little bit. Say you and your friends raise 250,000. And you get a bank to lend you 750,000. So with your same $1 million, now you're generating the same 250,000 after tax, and now you're getting 100% return on your investment. That's a company that I'm sure more of your friends are going to want to invest in that company. So demand will be there. On the technical side, And this will look a lot better when we actually look at some charts. But the things that I must have, the stock must be in an uptrend. In other words, the 200-day or a 40-week moving average must be going up. I make it a rule, I'll never buy a stock that is below its 200-day moving average. And why is that? There's been some studies that 98% of all stocks that have moved 100%, 200%, 1,000%, 5,000%, they've all originated, those moves have all originated above the 200-day moving average. So only 2% of stocks that have achieved monster gains have originated below the 200-day moving average. And so, like, where would you rather fish? You want to fish where the fish are. Second, the stock has formed a base above its 200-day moving average. And again, I'll show you in the charts, but this is just part of looking at a pattern. And my eye is, after doing this for dozens and dozens of years, is very trained for this, but it's not something that's really difficult to learn. I follow 3 major moving averages: the 21-day, the 50, and the 200-day. And they must be stacked in the right order. So the 21-day moving average is here, the 50-day moving average is below that, and the 200 is below that. So all 3 are trending in the right direction. It just shows me it's got some momentum. Relative strength rating of 85 or higher. This simply means MarketSmith calculates this for it, and it's right on the charts. But even if you're not using that, you should be able to figure out whether this particular stock is performing better than the averages. I think I point this out a lot of times in my nightly videos, that when the S&P is going down and your stock is flat or even going up, it's showing good relative strength. I like to see relative strength as rising. It's just it's showing more momentum. And I look at a shorter term relative strength line of 3 months. The one on the charts is based on a year, although it is weighted more towards the latter few months. But I look at a 3 months relative strength rating, and I want that 85 or better. I want institutional sponsorship, and I'd like to see that fund ownership is increasing. Again, it's the institutions that move the stock, and they can move it downwards as well when they decide to get out, but generally that's slower than the increase. Average daily volume of $20 million or more. This simply allows me to eliminate the low float stocks, ones that don't trade much volume, have very little liquidity, probably have a big bid-ask spread. So to put that in numerical terms, a $20 stock has got to be trading 1 million shares or more a day. Now this 20 million is actually very light, but I've widened that parameter so I can get some smaller companies into my screening mix. And the stock price must be within 25% of its 52-week high. Again, I want stocks that are trading near their at least their high, if preferably their all-time high, but certainly the last 52 weeks. Again, this notion of I want to buy high and sell higher. So a stock that's up around that level has a higher probability of going higher than something that's mushing along down the middle. And we're very quick to say, if I'm wrong, we buy it, and we're wrong, we're out quickly. So we keep our losses minimal. So let's look at a couple of examples of this that might help get this in mind a bit better. I'm going to pull up MarketSmith. And these charts, let me put this out of the way. Well, I can sit up there, that's fine. Let's look at, what's the first one I want to look at? DGII. And I'm not going to belabor these too much, but you'll get the idea. So this is, it's down here, we got the chart better. Okay, what we're looking at here is a weekly chart that goes back looks like 4 years. First thing I look at is the the pattern itself, and you can see that this thing came up off the COVID lows, has been basing now for better part of a year and a half. As recently, last September, it came out of that base and is now basing again. So we're looking for a resumption upwards. So back to my criteria that I'm looking for. I see the relative strength rating is 98. This is the 40-week moving average. This is the 10-week moving average. So it's above both of those, although last week it was below. This week it popped above. But anyway, it's enough to go on my watch list for further investigation. Over here is the sales, and they're growing 15%, 23%, 31%. That's good. Earnings growing 13%, 52%, 80%. Estimated they did $1.08 in 2021, going to $1.62 this year and $1.93 next year. So that's going in the right direction. And then I have MarketSmith has a little tab over here, which I've modified to suit me, but this looks at the first section looks at fund ownership. So last September, there was 291 funds that owned this stock. Now there's 339, so it's going up. It also tells me that this company is in the computer networking industry group. MarketSmith has 197 industry groups, and this industry group is ranked 21st. So it's in the top 10%. In an ideal world, you want to be looking for the best groups because they change from time to time. As we, in previous videos, we talked about sectors, and a whole bunch of money will go into that group as a whole. And then you want to find the best company within that group. So this is in the top 10% of groups. And then this particular stock ranking within the industry, I won't go into all the weeds here, but what's called a composite rating for MarketSmith. And there's 18 companies in this particular segment. And this one is ranked number 1. So it's got everything going for it. So it would go on my watch list. Next is here we have a medical biomed biotech company. So again, not quite as clean a pattern, but it came out of this stuff here. We've been basing, sort of wedging up, not as clean, mutual fund ownership has gone from 35 to 38, only marginally up. But biotech is the 5th best industry group and has been for about a month now in the top 5. And this particular company is ranked 7th out of 798 companies. So it's obviously garnering a lot of attention. Sales are going up exponentially, but from a tiny, tiny base, 7 million, 15 million, 18 million, 21 million, 25 million, and no earnings. So it goes on my list, but it's going to take a lot. This pattern's got to improve a lot before I will take it on. But again, the relative strength rating 99, it's above its 200, it's above its 50. You get the idea. Just quickly look at the 2 stocks I do own that I bought just a couple of days ago. Elf Beauty is in the cosmetics personal care space. It's putting in this long base after this rise up, so it's poised to go higher again. Relative strength 98, it's above the 40-week, it's above the 10-week. Institutional support, it's gone from 366 to 412. Industry ranking, it's only about a little less than midway, 119. This is I think Procter & Gamble's in this group and a few other companies. I can't remember exactly. So it's more a place to put money while you're waiting for things to die down. But there's 36 companies in this group, and its rating is number 1. Again, sales are growing, earnings are growing. I don't know what happened here in March, but you get the idea. This was more than on my watch list. I bought this one. And the last one is LPLA. And again, same thing. This is up. It's basing, it based again. Bit of a blip back here, and oh, this must be COVID. No, it's not after COVID. Anyway, so it's put in a base, and now it's really tightened along here, and now seems to be breaking out of the space. So again, 97 relative strength. It's above the 40-week. It's above the 10-week. You've got great institutional support. It went from 716 funds to now almost 1,100. So that sparked a lot of interest. And then some of the more prominent funds are now starting to be involved. Earnings growth slowing a little bit the last quarter. So that's a little red flag. Earnings, though, increasing 7%, 10%, 21%. So again, I think you get the idea. I'm going to move that out of the way. I've got I put together a watch list here of what I call the best of the best. It needs to be updated, hasn't been updated for a couple of weeks. But again, this is how I would look at things. I would start first basically looking at the chart and then the relative strength rating. And then I would throw this into a watch list. And we're going to go into that in the next video as to how we find the good stocks to buy. So I'm going to stop it right here, and we'll pick it up in the next video on how to use screening to be able to build a universe of a watch list of potentially high growth stocks. Not all are investable right now, buy right now, but things that should be on your watch list. So that's it. I hope you got something out of that, and we'll see you in the next video.